Hello, welcome back. This is Steven Yi. Today's topic is drying up. A very serious trend is emerging in the US housing market. At the end of this video, if you see a lot of value, please smash the like button and also subscribe to our YouTube channel. And finally, you may wish to subscribe and email to my link below on my website so you can become a free member of our real estate investing community. Thank you so much. And without further ado, let's dive into the purpose of this video. And the title is Drying Up. What does it mean, drying up? Well, you can find out momentarily. Drying up. What I mean by that is the outline will be coming up is ripple effect of housing inventory levels. Decades in the making, and it will be decades to resolve. Let's look at the dynamics. Single family home production permits falling off the housing market continues to weaken due to stubbornly high construction costs and elevated interest rates, all harming housing affordability and for builders to construct new homes. Permits are falling off the cliff. The builders, their ability to build and create permits is based on the interest rate because they need construction loans to finance their new builds because of the subsiding demand throughout last year, 2022, as a result of the higher interest rate. The builders are not ramping up their construction, their inventory levels. So this will have a ripple effect beyond the next couple of years, even a number of years throughout these decades to come, in my opinion. As you can see a chart right here, right? And the new build construction will supply a quite significant portion of the inventory other than the regular resales of current homeowners these days, which I will discuss that momentarily. That's the other pendulum swing, if you will. You see the graph of a gradual ramping up of new constructions over the past 10 years is still insufficient based on demand in the past 15 years, ever since the last housing crash in 2008. The last 3 years, as we have seen, the supply level was very low because of the pent-up demand and the historic low interest rates. And then throughout this past 2022, the permits and new constructions has subsided among all the major builders. So again, they are 32% off the projected production based on the nationwide demand of homes. As you can see, the steep drop in the new build sentiment and the confidence level has really fallen off the cliff, and especially when the new mortgage rate is around 6.8% now. So this will only exacerbate the new construction of homes to accommodate for the upcoming demand, not just for this year, 2023, for a few more years down the road. Who knows? All right. Now, the other component that will make a housing market healthy, if you will, and with the supply and demand imbalance, if you will. Look at this. Look at this chart. This is totally mind-boggling. Some of you already seen it. Some of you have not. Sellers are locked in. 9 out of 10 mortgages have interest rate below 5%. More than 40% of all homeowners don't even have a mortgage. So number one, we need stress sales in order for a housing crash to occur. There's no distress sales because homeowners are sitting on listen to this, homeowners are not going to get rid of a 3% historical low 30-year fixed rate mortgage to move up to buy a new home that potentially costs more and pay a 7% mortgage rate. They'll essentially double their mortgage payment if they were to do that. So needless to say, current homeowners are hoarding their mortgages. They are going to stay put, and I hope they're not going to sell. That will exacerbate the coming, once again, historic low of inventory. Yes, I know the demand of homes by buyers have taken a step back as a result of the recent rate hike, but that could be a temporary situation. So Let's move on. All right. So again, the people who have purchased not only the past couple of years, but over the past 10, 15 years, look at the massive amount of home equity. Look at the massive amount of wealth that was created by homeowners. We are talking a housing stock of 39 trillion with a T. So for those homeowners to have the wherewithal to purchase home to live in or as an investment home, rental home, I congratulate you. Your American dream could become a reality as long as you hold it for the long term and don't sell at a wrong time, which is right now. It is a wrong, kind of a wrong time. I know some of you have to do it. You have to sell. For those homeowners that have to sell for whatever reason, well, you have to suffer the consequences of the housing correction, if you will, but no crash. Okay. All right, let's continue. Again, look at this. Look at this. It's amazing, right? And 65% of current homeowners with mortgages that have a mortgage rate of 4% below, some are even have 3.5, 3%. Some almost 5 million homeowners nationwide have a 30-year fixed rate mortgage of 2.5%, and 13 million have mortgage rates of a little bit higher than 3.5. What's enticing a homeowner with a mortgage to sell their home? If the mortgage rate comes down to 5 or 4.5%, who knows, right? So until that happens, if the mortgage interest rate are still elevated for this year, 2023, between 6 and 7%, no common sense homeowners will even contemplate selling their home to move up to buy a new home. It just, not only the number does not make sense, in every possible way, it does not make sense. So that will continue to create an epic housing inventory crash. Notice I say the word housing inventory crash. Now look at this Altos research information dated last month, January 2023. This only entails single family homes. We need around 1.5 to 2 million homes or single family homes to create a balanced market of 5 to 6 months balanced market. As you can see, from the 2015, we have about 1.5 million homes of supply. Since 2015, we're talking the past 8 years, according to Altos research, we are steadily seeing a decline of housing supply of the inventory, especially during the historic skyrocketing of homes back in 2021. We've seen an extreme low level due to the historical interest rate, and that's why we're seeing housing prices increase in a historic way. But now in 2022, as a higher interest rate has created more inventory, as you can see, because of the demand subsiding, because of home affordability issue back in 2022, from the summer of 2022 until now, even inventory has creeped up, by no means from a low of 2021 at 200 or 300% level, but compared on a mere 8-year historical average, let alone, I'm not even talking about 30-year historical inventory levels, demand levels. Look at this. At the beginning of the year, as every spring season, every year, every spring season, we have tremendous activity, people coming out of that hibernation during the winter, during the holidays. And there's a lot of motivation for people to get off the sideline and buying homes. We have seen that this past January, until, especially when the mortgage rate went down to 5.99%, which is a psychological trigger. And now, in the past few weeks, the mortgage rate have increased all the way to around 6.8%. As a result, and the buyer demand have subsided, and the inventory, look at the inventory, have decreased as well. So anyway, now I want to show you this, because I've been doing investing real estate for the past 30 years. And our business model is such that I have relationships, or we have team of real estate agents in many markets that I do business with, that I refer our real estate investors to those markets. And I listen to them, what's going on in the local market. And they've been telling me ever since the new year started, 2023, that has been, listen to this, that has been in select housing market, not all obviously, in the select market that I'm aware of, based on the relationship and the communication by the local realtors, the network realtors that we have in those markets, and there are many, they are telling me that they have seen offers and bidding wars. I'm not saying the bidding war is quite gradual, like they're getting like 5 to 10 offers at 5 to 10% above asking. Now, this is a sample. As you can see, this is in Fremont. I lived in San Francisco Bay Area for the past 30 years. And my local realtor here, his recent listings in the San Francisco Bay Area, this is a small sample. I'm showing you just 2 houses, but there are more that have the similar scenario whereby this home, I believe, is $1.5 million in Fremont, in San Francisco, in the East Bay Area. And it was sold for, as you can see, for more than $100,000 above asking. And this other house, same thing, was listed for 1.5 million. There were several multiple offers and bidding wars, and because these homes are priced well, and because they have a great realtor, my friend Tony. Thank you, Tony, for sharing me this listing. And consequently, the buyer was able to secure this home and are paying $125,000 asking on this $1.5 million. So I'm sharing this with you because not only in the area, but my network of real estate agents in Florida and in Central Texas, with respect to entry-level homes that are like $300,000 to $450,000 single-family home, especially new build community. These homes recently, the past few weeks, has been selling like hotcakes. There's not enough homes remaining from the new builders with their great buyer incentives. And right now, those remaining new homes are being absorbed very quickly, right? So building incentives are going, the demand from those entry-level homes is very hot. So that's what's happening. There are little resemblance of multiple offers going on in those entry-level homes in those fast-growing markets like in Southwest Florida and in Central Florida and in Central Texas and around the Austin, San Antonio corridor. And so there's a lot of competition, not only from those well-qualified primary home buyers and real estate investors from out of state, but the hedge funds, Wall Street, and the corporate landlords are also converging on this very desirable, very limited, high demand entry level homes. So now let me prove to you. Now I'm going to segue into Griffin data, as I use this data quite often over the past few years. So let me further prove to you what's going on, why the title of my headline is drying up. Drying up, in my definition, is almost no inventory. I say it again. Yes, the demand has dried up too. That's right. Demand has dried up because of a high mortgage interest rate. The home affordability factor is at the extreme level. Very few people are able to afford homes, especially with the elevated interest rate, 6.8%. And so the demand has pulled back. The supply of inventory was reaching back to a historic level. And buyers, most those mainstream buyers not buying, and home sellers are sitting on the historical low mortgages, and the builders not building enough new homes because of the high interest rate environment. So we have a very interesting housing dynamics. But let me further share this with you. Let's go on. Now, I know median sales price has pretty much flat this past 2022 as a result of the last 8 or 9 months of home prices decreasing nationwide around 10% nationwide. Real estate housing market is very hyper local. Oh, by the way, now for those that I want to hear some more comments from you, please comment below as to what's going on in your market, what's going on with the sales and inventory levels, demands. I'm willing to bet if some of the comments can come in, you can say, yeah, in my area, there are very little inventory. We're seeing a little bit of bidding war. Houses not coming down. Yes, I get it. Oh, by the way, those luxury homes, those high-end luxury homes like 700K or above, yes, they are going through a very much a deep dive reduction of prices. But in good markets, in fast-growing Sun Belt markets, especially in the South and Southeast, we have seen home prices really rising in those entry-level homes in those growing sub-markets such as Southwest Florida, Central Florida, and Central Texas, and few more areas like in North and South Carolina, and few areas in the southern states. Even in those are called Sun Belt states, South and Southeast. But even at the western region of the U.S., the typical boom and bust town like Vegas and Phoenix and Boise, Idaho, and few other places, we are seeing very low inventory, and we are seeing a lot of housing activities going on in those markets too. Go figure, right? So okay, let's finish up with this. What's going on with the inventory level? Now, again, Redfin, they only report their 400 markets that they track. But let's go over the month of supply, which is, again, 5 to 6 months is a balanced market. Economics 101. If demand exceeds supply, we can have a healthy real estate market uptick. So let's look at the end of 2022 reported there are 12.9 weeks of supply. So divide 4 weeks by, let's say 13 months, 13 weeks, like a little bit over 3 months of supply inventory toward the end of last year, 2022. And then year to date, 2023, there's a slight uptick in inventory because of the buying season. We're seeing 16 weeks of supply divided by 4. We have about 4 months supply inventory, at least temporarily, and still a very low supply of inventory. And look, if you've been watching any YouTube channels or any mainstream video, you will see last year, look at the trends are indisputable. Look at the new listings in 2022, but they're on this black line. Okay, the new listings have been increasing toward the first half of 2022 on this black line, but then when the interest rate has decreased, you have seen the new listings have steadily come down nationwide for the remaining 6 months of 2022. See the steep decline. This tells you that the homeowners are not listing their homes because of a high rising interest rate, because of the lock-in effect, and the buyer demands have subsided. Also, even with more listings last year, there's not enough homes sold due to the affordability factor and what have you. And then that's the new listings. What about active listings? Same thing. Active listings, there's a ramp up in 2022, the first 6 months until the summer when the interest rate went skyrocketed from 3.5% all the way up until October of 2022 when the interest rate went up to 7.3%. And before the rate came down gradually, and yet the active listings has also coming off as we are moving toward the first couple of months of 2023. Now, on this blue line, you have seen active listings have been decreasing day over day, weeks over weeks, month over month. So remains to be seen on this to see what kind of trends, what's going on. All right, so let me see what else. I think I'm done talking. So clearly, the Altos research, right? You saw there are around less than 500,000 homes projected to be sold. Think about this. Now, some of you are going to argue, confront me, going to say, oh, the listings will continue to go down in prices. Maybe in certain areas, like high price areas, and where I live in California, yes, perhaps that's true. But in most markets, you'll be the housing prices maintaining very low, because look, 500,000 homes of supply. Let's say this is the level based on Altos research, as I show you. You have to believe in a nation of 350 million, in a nation where millennials, which is a prime buying years, consists of 78 million millennials in a prime buying years, and there are only 500,000 number of homes. Okay, let's look at this. But you're going to tell me in this nation, 500,000 people cannot afford to buy a home with or without mortgages? Let me break it down even more for you as I conclude this video. Investors buying homes. This is my space. I'm in the business of helping investors buy cash flow homes in the good entry-level affordable markets for cash flow, turnkey cash properties. Okay. So you don't investors, there are a lot of all the homes being purchased out of these upcoming low-level 500,000 homes of available home supply inventory, which is extremely low. Out of the 500,000 homes, 20% of the upcoming will be achieved by investors. Out of the 20% of investors buy these homes, around one-third of them, one-third of the investors are buying those all cash. It just does not matter to them because they have deep pockets, they have a long-term buy and hold scenario, and they love the single-family home asset class housing stock because over time that it produces good return and good yield. And then you have Wall Street hedge funds that are the corporate landlords that are buying a small portion of this available for 500,000 homes, according to Altus research. They are buying in all the hot Sunbelt markets too. They consist of maybe only 5% of the housing inventory, but their percentage level of ownership, the Wall Street hedge funds, corporate landlords, are increasingly, or at least they could have they want a bigger piece of the pie of the housing stock as we speak over time. And then you have regular home buyers that have the money to buy. They are okay with a 6 or 7% interest rate. They could still and they will buy because they have a new reset. It's a new normal. They are content with a higher mortgage. The days of 3% historical mortgage rate are over in our lifetime. This is a once in lifetime phenomenon in 2021. So once the highly qualified home buyer can take the piece of the pie of the remaining 500,000 supply inventory, which is extremely low for at least for these next few quarters. Who knows about the future? All right. So they will be qualified buyers. They will take the plunge. And it's very unfortunate that many home buyers are sitting on the sideline because either they can't qualify, they don't have enough down payment, because on the home affordability factor, that is sad. They may be sitting, many prospective home buyers will be sitting on the sidelines for a long time to come, and they will continue to be being renters. Sad to say, if you continue to be a renter, you are not achieving your American dream because you are achieving your landlord's American dream. As a renter, you are making the landlord rich. You are paying their mortgage for you. Think about that for a moment. All right. So you want to be a renter, or you're going to be a homeowner, or you want to become a landlord. Okay. Choose those options. Okay. Here's the bottom line. The bottom line is today's topic is drying. That's right. It's not a doom and gloom. It's not clickbait. I'm giving you the reality of the world. If you can afford to buy, if you want to live at your house, for those primary homeowners out there, if you have a long-term buy and hold strategy, 7-10 years in the future, who to say you shouldn't buy even at a 6 to 7% mortgage? As long as you can afford it, you have a good stable job, you have good cash reserve, and you have the down payment, you have the credit, whatever. If you love to live at your place, at your neighborhood, at this upcoming neighborhood, and you want to raise your family there, pull the trigger. Don't time the market. You just, anyway, and for investors, I tell you, investors, of course, you buy not based on mortgage payment. You buy based on cash flow. You don't buy the interest rate in a way does not matter. What if you buy an investment home, and even if you're paying 7.5 mortgage rate, whatever is the monthly mortgage is, all you have to do is to find a property and find a renter that will pay your monthly rent, that will cover your monthly mortgage as a landlord. You'll be fine. And that's what I do, by the way. You're gonna buy, investors buy for cash flow, you buy for lower end homes, $200,000 to $350,000 range for new construction, single family homes in the South and Southeast. You can buy in the Midwest for 60 to 100 grand, 150 grand, and have a very high rent to value ratio. So anyway, so I'll let you go now. So enough drying up. At the end of the day, to recap, we are continue, if the interest rate continue to be at 67%, we have a very low inventory. The current homeowners, they are locked in, they're not going to sell. Okay, they're going to sit on their historical low mortgage for the rest of their lives. Okay. And the new builders are not constructing, not enough new builds, not enough entry level new builds for, especially for first time home buyers, VA buyers, FHA buyers, and conventional buyers out there. There are very few homes out there. You can afford it, pull the trigger. Otherwise, you continue to wait on the sideline. Guess what? You might be waiting for a long time to come. So if you see, we see a lot of value from this video, please smash the like button and subscribe to my YouTube channel and make comments below whether you agree with me or not. And just make your comment be reasonable. I will respond to them. And of course, finally, subscribe to my email on my link on my website below so you become a free member of our real estate investing community. With that in mind, this is C. We'll see you on next video very shortly to talk about what's happening in a daily, in a weekly housing market and real estate investors community for buying cash flow turnkey homes in very good markets with great investment long-term methodology. Thank you so much. We'll see you. Have a nice day. Bye-bye.